All right, so my next guest says navigating this market. By the way, she's been navigating it superbly for a long time. And while she remains constructive, she does say that the setup for continued near side upside is much more difficult than it's been. So let's bring in now Partners Group Managing Director, Chief Investment Strategist for Private Wealth, Anastasia Amoroso. And let's just get started with these headlines, right? So we start the day off, and China's going after rare earth yesterday. Today they're going after chips companies, NVIDIA, Qualcomm. President Trump says, okay, you know what, we may not meet, we may have to go maximum tariffs, sets up this pre-fall in the market, this pullback in the market.
That's right. Well, the operative word may. It doesn't necessarily mean that we're not going to get a deal, but the markets are reacting to any headline, to your point, Charles. You know, the market was set up for perfection here. The expectations are incredibly elevated across the board. They're elevated about earnings, they're elevated about the economy, they're elevated about the labor market, and of course, there's optimism about the AI trade really continuing the momentum near term. And I have a degree of skepticism around all three of those things.
Is your skepticism long term now? I mean, do you think the AI trade is over, for instance? Or, I mean, sure, you see the bottoming out. The labor market, what are you skeptical of, that it's weakening and that the Fed should be cutting, or that maybe it's weakening more than we know?
That's the point, is the labor market is clearly weakening, and we don't get the official payrolls data, but we got the alternative data suggesting it's weakening, and yet everybody assumes that it's not going to spill over to anything else, that the labor market is going to continue to be resilient. That's a question mark for me. As far as the AI trade goes, you know, clearly we're building a whole lot of capacity, but the question is for what? Will the killer apps actually surface? Is OpenAI the killer app? But I think we need something else. So that's what I'm kind of skeptical about near term, because there's a lot of capacity. Where's the payoff?
Is there a chance, and I've been asking this question, you know, we all lived through the jobless recovery kind of thing, right? That when that phrase is popular, could we have a paradigm shift in our economy where AI does just enough that we actually do have less jobs, fewer jobs, but greater prosperity? Can that exist?
I mean, that's in a way what the market has been setting up for, and that's what it's been experiencing, because the labor market has been weakening for 3 months, and yet the market, the S&P, has been roaring. So I do think, Charles, that, for example, people worry about inflation, but if you have the combination of AI on top of everything else that's going on in the economy, we might actually put a cap on inflation. And look, near term, I'm skeptical about the AI momentum. Longer term, it is clearly a shortcut to productivity. And I think the opportunity is immense across sectors. So yes, I do think that it could be a more tempered labor market, and yet productivity that picks up.
So let's talk about one thing that you think could be a tailwind, right? Rate cuts. I mean, you say it helps in a lot of ways, right? Improves cash flow, can maybe offset tariffs, improve real estate. But we see maybe mortgages coming down, and short-term equity valuations. How many cuts do you see coming?
I see another 2, and I will say near term, cautious, longer term into 2026, optimistic, but that is contingent on the 2 more rate cuts, because if we do have 75 basis points all in, it can improve the cash flows, because companies are clearly absorbing some of the tariff costs, so they need an offset. It can certainly improve real estate valuations, for example, or private equity valuations, or valuations in general, so that would certainly be supportive as well. And most importantly, it could improve the labor market, because what do companies do when they're uncertain or when they're absorbing costs somewhere else? They're holding off on hiring. Maybe they're even laying off workers. So if the Fed could cushion that by getting some of that cash flow back to them from lower interest rates, that would help.
All right. So just real quick we didn't get the jobs report, right? What if it had come in negative? I mean, we're playing a guessing game. What if it feels like maybe the Fed is so far behind, the next cut has to be 50 basis points once we get the data?
Yeah, well, we forget the data. And, look, whether you get 25 basis points at the end of this month, or whether in another, 25 basis points in December, I think it's close enough for the Fed to say we're going to assume this measured approach. But I do think they need to act, Charles, because we got the ADP numbers, and they were negative last month. They were revised to slightly negative the month before. And so, whether we act 2 back-to-back or 50 basis points, we'll take it either way.
Let's talk about sectors, though. You are still seeing opportunities in the markets, and this is just in the publicly traded markets: financials, healthcare, industrials, data center, and power generators. Let's go to industrials, because you had sort of a note, because we know, like, home builders, for instance, have been bringing industrials down. This was the #1 performer for a while. It's slipping a little bit, so you have to be selective, right?
You do. It is a cyclical sector, but at the same time, it is, is really underpinned by a lot of the secular trends that are happening. If you think about what this administration is trying to do is cause a wave of onshoring, and I think it's likely to be successful. So it's all about localization and duplicity of supply chains, and to do that, you do need quite a bit of those industrial activities.
All right, let's talk private markets versus public markets. The value proposition for you is pretty clear. Cheaper valuations, greater opportunity, faster earnings growth, better profit margins. Is there anything that we should be worried about? Some negative headlines have come out about, private credit. Some things have blown up here and there. We see stocks like Blue Owl pulling back. And by the same token, retail investors have clamored for access to this for a long time.
Right, and they're getting access to that. No, I wouldn't necessarily say, Charles, I am worried about any of those things. I do think the rate cuts actually go a long way to support private markets, but I'll take it a step further and say I'm worried near term about the public market volatility. And one of the reasons why this is even a greater point to emphasize right now is because private markets do give you that diversification. For example, infrastructure has about a 0.24 correlation to global 60-40. Private credit gives you that yield boost relative to other things in fixed income, and private equity is not going to whipsaw like public markets are going to whipsaw on each headline.
All right. And just sort of follow what the rich folks are doing. If you can. I mean, get access to it.
Well,
this is what you're trying to do, right? I mean, partly what you're trying to do.
That's right. Increasingly you can. And we've actually had a private equity evergreen solution for private clients for 16 years. So it is increasingly accessible.
Great stuff. Oh, I'm so lucky to have you on a day like today. Thank you so much. Appreciate it.